Good morning, everybody, and welcome to this Tuesday, May 6th, 2025 edition of Trading Places live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist at Earnings Beats, and it's a pleasure to be with all of you today. Got maybe what looks like the stock market rolling over after a pretty lengthy winning streak. We've seen huge gains off of the early April low across our major indices, and now I think it's going to be time to see what the bulls have. I really like what's happened in terms of this rally. I like the underpinnings of it. I think that bodes well for the longer term, but short term, it's like any other advance. I mean, we've gotten really long in the tooth here. We've had a huge rally. I mean, we were down at 48.35 on the S&P 500, rallied back at 5,700 yesterday. I mean, so that's what, 865 points in a month on the S&P 500. So that's quite a bit. And certainly time for maybe a little bit of a reprieve. I do want to recognize those of you in the chat room. Pretty, happy to see everybody again. We have had a little bit of a hiatus over the weekends, the last couple of weekends, but we'll get back into doing the weekly market recap. I've had a couple things going on, so unfortunately haven't been able to record, but we should be back in gear this weekend. And again, just want to shout out to everybody this morning. Those of you watching, really appreciate your viewership. Make sure you hit the like button and subscribe to our channel so you don't miss any of our future content. But let's go ahead and get this thing rolling. So I want to start off with taking a look at what happened yesterday. So finally, the winning streak came to an end. I think the S&P, I'm not sure exactly how many days we went up in a row, but it was a lot. And yesterday, you can see red across the board. The only thing green, at least in terms of this summary, was the VIX, which when the VIX is going up, usually that means the market's going down. So we had the Dow Jones Industrial Average finish down 0.25%, S&P 500 down about 0.2%, NASDAQ down about 0.75%, and the small cap index was down about 0.8%. So that was your laggard on the day. We were up earlier in the session, but we did see some selling into the close yesterday, and as a result, we did snap our winning streak. By putting in those lower lows, and it looks like we're going to have lower lows to start the day, at least as of about 20 minutes ago. So let me give you the latest there in terms of futures. So bear with me. The market will open in about 27 minutes. And right now we've got the diamonds, which track the Dow Jones Industrial Average, down 0.65%. We've got the spider tracking the S&P 500 down about 0.8%. Then we've got the QQQ, which is a little bit more aggressive, tracking the NASDAQ 100. That is down 1.14%. So we closed yesterday on the QQQ at 485.93. Right now, pre-market, we are showing 480.37. So a gap down potentially of about $5.50. We've been looking at this throughout 2025, these gap downs, which a lot of times have been followed by some strength later in the day. That'll be something to watch as we move back down. A lot of times these downtrends, these moves to the downside, whether it's correction, whether it's a cyclical bear market, in this case, we now know it's at least a cyclical bear market because we went down more than 20%. And that's the general threshold. But a lot of times in these bear markets, I think the most important thing is the first big rally we have and evaluating that rally as to whether or not it's something that's sustainable or whether it's something that's likely to fail and roll over. We're going to take a look at some other charts later in the show to kind of help us with that. But I'm seeing some pretty good things I saw some pretty good things in this rally. So that makes me much more hopeful during any market decline that it is not going to be something that's going to be horrible. Could it morph into that? Of course, market can do anything it wants. I'm just looking at some of my secondary signals that I put a lot of trust and faith in. They help me call the market tops and bottoms. And if you've been following us at Earnings Beats for a long time, last 5, 6, 7 years, we've done a pretty good job of calling tops and bottoms. Well, it's these secondary indicators that I rely on a lot for those types of calls. Because if you're just looking at price action, when you're going and you're at a new low, price action's horrific. I mean, it's at a low. So if you're just looking at price action, you're not going to call the bottom. But if you look at some of these other signals, it just gives you some hints as to where money is rotating. what Wall Street might be doing in terms of accumulation. Where are they accumulating? How much are they accumulating? I mean, all those signs, in my opinion, are really important to the direction of the market as we look forward. So anyhow, let me finish here. IWM, we didn't look at small caps. Pre-market, IWM down about 1%. So it does look like we're going to gap down at the open today unless something really changes here in the next 25 minutes. And so that tells me that we've got a 2-day losing streak working, at least in terms of lower lows. How we finish today, who knows? We're going to find out. Also, really important, today marks the start of another Fed meeting. Tomorrow at 2 p.m. Eastern, we'll get the latest Fed announcement. I think just about everybody is assuming that the Fed's going to do nothing. But what are they going to say? Because there are a lot of folks beginning to bet now that they might cut in June. If they're going to cut in June, I think you're probably going to hear something about that in today's or in tomorrow's policy statement. So I think the next 2 days are going to be big. If the Fed takes a hard stance and says, hey, we're holding steady. We did just get a pretty good jobs report on Friday. There were a lot of economic reports that have come out recently suggesting maybe things are slowing down, which I thought might put a little bit more pressure on the Fed to talk about cutting rates. But the jobs report was stronger than expected on Friday. I don't know how much impact that's going to have. I'm assuming the Fed probably has the inflation data that we're all going to get next week. But, you know, where does the Fed see inflation going? What about the tariffs? Are they getting enough information where they can make some kind of a call? Is the cloud of uncertainty, is it, you know, vanishing or is it worsening? All of these things will be looking to get some clarity, hopefully get some clarity from the Fed tomorrow at 2 p.m. So the market, I would expect to be pretty volatile after that announcement tomorrow. That's typical. Normally, you know, heading into a Fed meeting or an announcement, I tend to see the market gravitate to key levels, key price levels. So that's what we'll take a look at here as we go throughout today's show. So let's move on to the S&P 500. What does the chart look like? Well, I mean, I can tell you some real positives on the chart without question. PPO is positive. The daily PPO is turned back positive. That means that the short-term moving average has crossed over the long-term moving average. And we talk about the PPO, the default, the short-term moving average is the 12-period EMA. The longer moving average is the 26-period EMA. So when you see the PPO cross the center line, it's telling you that the 12-day EMA, the short-term EMA of the S&P 500 has crossed over the long-term. So it's like momentum is shifting and we're starting to get that move to the upside. Now, a lot of times what you'll see is failure at the center line or maybe just above. And you can see examples of that back in January and February. We were negative, we went positive, didn't really get that far positive, and sure enough, rolled back over again. Sometimes we go above and we stay above for a while during uptrends. Check out early August through the early part of December. That was a clear uptrend that we were in. The entire period, PPO was positive. It would go back down to the center line, test it, bounce back off. Well, I mean, if you're looking for an uptrend, you've got to get the PPO in positive territory. We've done that. So this is at least the beginning of something that looks like it could be bullish. I think everybody should recognize that. Even the most bearish folks out there should see, hey, the PPO has gone positive. You don't want that for very long. The other thing that I like about this move is that with this PPO rising like it's been doing over the last month or so, check out the last couple of tests when we've gotten through the 20 and we've come back down to test the 20-day moving average. They've held. Downtrends, usually you go up to the 20-day moving average and you fail and you go back down. So, and that's not to say that we've never had a downtrend where you go above the 20-day and then go back down. I'm not saying that, but we've now been above that 20-day moving average for about 8 straight days. That's a good sign to trade above that 20-day. You don't normally get that much strength for that long in order to stay above something like the 20-day moving average. But not only have we stayed above it, but we've tested it a couple of times and then moved back to new highs, which I find, again, to be increasingly bullish. The other thing is, as we've rotated and moved back to the upside and gotten through these key moving averages, notice the volume. Volume has not been light. Volume has been, moderate to heavy on this push back to the upside. We haven't had any panicked buying days, but you never have panicked buying days. How many folks do you know that are panicking to buy right now? Most people are still trying to figure out, why are we going up? There's nobody panic buying out there. That's not what the market does. The market panic sells. The market almost never panic buys. I would say one exception was a couple of weeks ago when the NASDAQ had its second best day ever, and the market just kept going up, up, up all day long, like 11 or 12%. There were probably folks that day that probably started to panic buy, sitting on the sidelines, or maybe panic cover if they were shorting. But usually the volume of companies selling, the bigger volume of companies selling, which is why a lot of folks get it wrong when the market comes back up, because they always say, well, volume trends are weak. We went down on heavy volume or coming back up on lighter volume. Look back at history. That happens almost every single time. So that's not breaking news. The market sells off on a lot heavier volume than it, we're going to see a lot more panic on the way down than we will on the way back up. Let's see what else here. RSI right now got up to almost 60. You can see it's starting to roll back over here. Zero in down here. See how it got up almost to 60? During downtrends, RSI 60 resistance is a real thing. So getting up to 60, not getting through, starting to pull back, that would be an argument or a check mark in the bears column. Didn't get through 60, failed, starting to roll back over again. Now we break out to a new high and the RSI goes above 60, then it's going to be a check mark that slides over to the bulls column. But I would indicate that these check marks I'm talking about are mostly short-term check marks. All right, a couple things I want to talk about here today, because this is one that is really, when I talk about, market tops or whether we're topping or how long we might be topping, I do like to look at some of my secondary indicators. And one of them, and this is the one, this is one I started using back in 2022 during that cyclical bear market. I was just noticing that, the market seemed to be moving up during the day a lot more than it did like at the opening bell. So if you go back to May and June of 2022, you'll see a lot of gap downs followed by intraday buying many times. And over the course of that month, it's not my opinion, it's fact. If you take cumulative readings of all the gaps during May and June of 2022, you'll see that the net was clearly the market gapping down, but then buying resuming throughout much of the day. And so what we saw, in my opinion, was media headlines, horrible news in a downtrending market that was sending a lot of retail traders to the exits. Folks were panicking out, they're selling, which is what the big gap downs represented. In some cases, in my opinion, it actually triggered the retailers. When you wake up and you see your account, you've already gotten, bludgeoned in your portfolio, and you wake up and you see you're down another 3 or 4 or 5%. You can only take so much of that before you finally just say, I'm throwing in the towel, selling, I'm getting out of everything. I never want to see the stock market again. And unfortunately, when the masses start acting in that fashion, normally that's about when a bottom's going in. So that's what we saw back in the middle part of 2022. This chart is effectively visually showing you that the same thing is happening right now that happened back in May and June of 2022. This right here at the top, this top panel is looking at the ratio of consumer discretionary versus consumer staples, but it ignores gaps. It excludes the gaps. So all this is telling us is how discretionary is performing versus staples during the trading day. And if you look back to the March low, mid-March low, I'm going to call it that March 13th low. Let's go back to the S&P 500 for a second. Right here. Since the March 13th low, we're up maybe 150 points on the S&P 500. We're just slightly above where we were. But I want you to look at what the intraday, where we are versus where we were. Nowhere close. We have exploded back to the upside. And look prior, look in, back in December, we actually topped in this ratio 2 months before the S&P 500 topped. So this was a little bit of a warning sign, and one of the things we talked about. Quite honestly, at the end of January and throughout February, I kept talking about it's very cautious, the market. I thought the market was preparing for a drop. Got to be careful, whatever that means to everyone out there. Well, we dropped. And not only did we drop, but take a look at how far this XLY XLP ratio dropped. And this was the intraday move. If you go to this middle panel right here, this includes everything. So this includes the gaps. Notice that we kept going higher until January on this chart. Intraday, we started seeing that selling a month earlier. That's Wall Street. Picture it. Wall Street getting out, seeing moves to the upside in the morning. Wall Street getting out of discretionary, moving into staples, while going on CNBC talking about these all-time highs that we were seeing. Down here's the S&P 500 over 6,000. So you got to separate the noise, which is CNBC, from the truth, which is exactly what you're seeing on this chart. Follow the charts. Do not follow the headlines. Do not follow CNBC for your market guidance. They're gonna be late to every party, and I could say it's intentional. I don't know that for a fact, but again, there's quite a conflict of interest between what Wall Street says on CNBC and what they're doing with their money. This tells me a little bit more about what they're doing with their money, and they have been pouring into the more aggressive consumer discretionary names. So I see that. I mean, look at this is the one that includes the gaps. Since the middle part of March, we're effectively right where we were. There's been no change, because what's happening is we're seeing sell-offs in the morning, recovery in the afternoon. So in the end, if you include the gaps, you really just been treading water. You went down, you came back up. We're right where we were a month and a half ago. But again, you look at the intraday, ignore the gaps, ignore that, what I call manipulation, because I think that's all it is. I think when you get into a very emotional market with a volatility index in the 20s, 30s, 40s, 50s, 60s, it's an emotional market. And so traders do react to these headlines and the panic that seems to be out there. I mean, I don't know about anyone else. It seems to me like the market has kind of gone back, not normal, but certainly recovered and seems to be much better than it was a month and a half ago. What changed? I mean, yeah, I mean, we backed off of the tariffs. That certainly changed. But is there no more inflation? I mean, have we decided that's not a thing anymore? The economy's okay. I don't know. Anyway, yeah, I stay away from the news, and I think all of you know that by now. So here's the S&P 500, went down, it's come back up, but this rally is being supported by a lot of intraday buying in aggressive areas of the market. Let me show you another chart. S&P 500. Here you can see the S&P 500 is still a little bit below where it was in the latter part of March. So this isn't the middle where we bottomed, but after we rallied. And now we've rallied now, and looks like maybe we're going to start to roll over. So look at the S&P and S&P 500 and what we've done since that late March. So we've gone down, we've come back up. A lot of folks thinking we're just going to go, dropping, declining, whatever, rapidly descending back down to lows, maybe new lows, maybe testing the old low, whatever. I'm not saying it can't happen, but based on what I'm seeing, I think the odds are decreasing almost every day that we're going back down to that low. I'd be shocked. Well, I wouldn't be shocked, but I would be surprised. But anyway, here's where we're almost back to where we were at the end of March. Now, I want you to look at this panel right here. This is large cap growth versus large cap value. Now, as we went down, it seemed like we started to lose the momentum to the downside. I mean, we've mostly been going sideways in March and April, but as we began May, you can see that we actually moved up from where we were back in the latter part of March. So even though the S&P 500 has gone down, the growth versus value ratio has gone up among large caps. If we go down to the next panel, this is the mid caps. And again, look at when we topped on this growth ratio. This was back in December. Just like, I talked about with that XLY XLP ratio, intraday topping in December. Here's another one. Growth versus value topped in December. So the performance of growth stocks versus value stocks started going down for 2 months before the market started to roll over. What do you think was happening during those 2 months? I can tell you what I think was happening during those 2 months. Wall Street was moving out of growth and into value. They weren't telling us, well, they were telling us on the chart, not telling us on CNBC. And then we come down, and all of a sudden, we start. I mean, we took quite a tumble from the March low to the April low. That was a significant drop. This started to slow. We didn't put in a higher low, but it definitely started to slow in terms of money rotating away from growth. And now as we move up, you can see again, large cap growth is ahead of where it was back at this S&P 500 top. Look at the mid caps, growth versus value. Pretty clear. How about small caps? Small caps, growth versus value. So again, you tell me, why is all this money rotating into growth if we're getting ready to go back down because we got this recession? We might already be in a recession. I wouldn't be shocked if they come back later and tell us that we were in a recession. They're not going to tell us while we're in it. They're going to tell us after it's over. And the stock market's going to be moving up before the recession's over, which I think could be what's happening now. But why would you want discretionary stocks versus staples? Why would that ratio during the day be shooting to the upside? Why would growth versus value be leading to the market? I mean, on a relative basis, why would growth be beating or leading value stocks if Wall Street truly believed that we were going back down again, maybe to set new lows? It would make no sense. So again, this isn't just a bounce. This is the S&P hasn't gotten back to this high, and all three of these growth ratios are already through those highs. And again, discretionary versus staples. Money is pouring into discretionary during the trading day. So, you can say what you want about it, but to me, it's pretty clear. I think Wall Street is accumulating, not because we're going back down, setting new lows ahead, but because probably in 6 months, stock market's going to be a lot higher than it is right now. All right, another thing, I want to show you sentiment. So at each one of these highs, this is the S&P 500 on the top. Down the bottom is a 5-day moving average of the equity-only put-call ratio. Now, if you look at, first of all, it's an equity, it's a put-call ratio, equity-only put-call ratio. Put is the numerator, call is the denominator. So when folks get really fearful, the puts start going up relative to the calls. So your equity only moving average will start to rise as the market gets more and more fearful, or as retail traders get more and more fearful, or options traders get more and more fearful. It goes down when the puts are not being bought as much, and that ratio starts to decline. That means there's more calls being purchased and traded versus puts. And that's a sign that the market is getting complacent. And when you start reaching extremes either way, historical extremes, we have some guidelines that we follow. When we get to historical highs and lows, it's just telling us that from a sentiment perspective, we could expect to see the market reverse. So again, as you're going up, you're getting more fearful. See the stock market dropping right here, and see how we peak up above this 0.75 level on a 5-day moving average? That marked the bottom. Here, we go through the 0.75 level. We mark a bottom. Same thing here in September. We mark a bottom. Guess what just happened? We almost got to 0.75 beginning of April, and the bottom was marked. Now, how about the tops? Now, we did go through a period where we started to get very complacent, October through January, which I think was another sign that, hey, maybe the market needed a little bit of a pause. So it wasn't just the rotation. When I start to call tops and bottoms, it's all of the indicators coming together. It's not me trying to find one or two that support the market going down or up. I could always find one or two to support either way. It's when you get a lot of them starting to line up and telling you the same thing. That's when I think it's time to take notice and to say, hey, market's getting a little riskier. Or on a bottom, hey, it's too risky to stay out of the market. You want to be back in. Folks are getting too fearful. That usually marks bottoms, those types of signals. So anyway, there's your green arrows saying it's time to buy, and you can see they were almost perfectly timed. Here were a few just where you would go down, hit this 0.55 level, you can see mid-May, and I'm going back over the last year. Mid-May, we pulled back a little bit, marked a little short-term top. It wasn't a bear market. That's not what this tells me. It tells me that we're short-term. We've gone too far in one direction or the other. Middle of July, hit a top. That time we did have a little bit more. I think we had a correction or close to a correction. Maybe, I don't think we quite got to a correction, but close. Fast forward, March of this year, right here, we would come down, we went back up, and we went back up. All of a sudden, everybody was pouring back into calls again. We got complacent, market dropped. And now look at where we are. So again, if you're wondering, why, I wrote an article over the weekend at Stock Charts talking about this could be a top. This could be another short-term top. And this is one of the reasons why we've got sentiment showing us that on this rally, options traders are getting a little complacent. Now, we've seen complacency stay in place for a long time. Calling tops based on sentiment, in my opinion, is not nearly as accurate as calling bottoms. Bottoms are almost every time when you get capitulation and all the option traders are jumping into the puts, that almost guarantees us a market bottom, either there or rapidly approaching. This just tells me, hey, got to be a little careful. Short term, we're getting a little frothy, a little overbought. A lot of folks jumping into the options on the call side, and that just tells me that we could have another one of these little something like this. It could be more. It doesn't tell me. This signal doesn't tell me how far we're going down. If we go down, it's just telling me that, hey, you got to be careful here. So understand the signals and what they tell you. Don't just say, oh, well, this is flashing a sell sign. That means the bear market, we're going to new lows. That's not at all the way I read these signals. All right. For those of you that are new to earningsbeats.com, I just want to welcome you to our website. You can go to earningsbeats.com, both plural, earningsbeats.com. You can sign up, start a 30-day free, no cost. That's what free means, free, no cost trial for our service. You do need to give a credit card for that so we can get you set up in our system, but there's no charge for 30 days. We will let you know when your 30 days is expiring. Normally, we're going to give you a good offer for an annual to try and help you save money. But my point is here, we're not just going to ignore it and hope you forget about it. We're going to let you know. We want you to be a member if you want to be a member. A couple other things. If you are new and you just want to try, check out some things, this is an absolute necessity. This is a free report, free as in no credit card. This is basically a summary of all the work I've done on the S&P 500 historically since 1950. So don't believe the go away in May. I figured it's a good time to mention this because at the beginning of May, I saw an article over the weekend about going away in May. Go away in May is a old wives' tale. It's an unproven theory. There are some things about it that I would say are correct, but it leaves out a lot. It's to just to give a blanket statement, go away in May, is doing you a lot of financial injustice. So you want to learn more about how the stock market works historically, make sure you go to earningsbeats.com, click on this free report. It's going to reveal market trends for the past 75 years, since 1950. Goes back a long way. Anyhow, if you want to sign up for our free newsletter, Earnings Beats Digest, this one's completely free, no credit card required. Comes out Mondays and Wednesday mornings. Name and email address, all it takes. Sign up. We have tens of thousands of folks that have signed up for this newsletter. Why wouldn't you? It's free education, potentially a trading candidate once in a while. If you decide, that's completely your responsibility, but you could use it as a trading candidate if you'd like. Make sure you check that out. If you're wondering about Earnings Beats, our portfolio, our model portfolio has absolutely crushed the S&P 500 over the last 7 years. We pick 10 equal weighted stocks every quarter. Follow them versus the S&P 500. After 90 days, we take them out and put 10 new ones in. Or some of them could be the same. Might keep one or two or three that continue to do well. They might stay in the portfolio. But every 90 days, we reevaluate, put in what we believe are the best 10 stocks, equal weighted. And that's been our history since back in the fourth quarter of 2018. So make sure you check all that out. All right, it's 9:30. What I want to do is just quickly talk a little bit about some companies that are in the news in terms of earnings today. So we got Palantir. Let's see if we're getting an update here on Palantir. Yep, there's Palantir down $13 at the opening bell today. I saw they beat, and I believe they raised their guidance too. But this is a stock that if we look at a long-term chart, just went up and tested a major top. So what I see is a cup. Wouldn't be surprised maybe if we get a handle down to the 20-day, maybe even down to these prior highs right here, closer to 100, maybe 99. But 105 is the 20-day moving average. So that's something I certainly would watch. And this is a listing. This is one of the things we do for our members every single week during earnings season, is we give them all the companies that reported yesterday after the close and today before the open. We do that every single day so that you can quickly look at every stock and how they're performing after their earnings report. So if you want to see, let's say we've had 150 companies report since yesterday closing bell, you can go in and type in individually 150 stocks if you want, see how they're doing. Or you can download our chart list that has all 150 on it and then simply push the button on an update on the summary. So we're viewing as summary. And this is in market cap order of companies that reported yesterday after the bell, starting with 0001. And then after you get through all of those down to 0070, you'll see a new set start 1001. This is market cap order of companies that reported this morning. All right. So all of them are on one list. I'm going to hit this summary, or I'm going to hit this update. Market is open. And so based on market caps, you can then take a look at how all these stocks are doing. But you also can just hit percentage change and just see what best reactions are. Look at Upwork there, 13%. Neurocrine Biosciences, 14.6%. Talos Energy, 15.91%. I can tell you since yesterday's close, here are the 5 best stocks. That's pretty cool to be able to summarize this stuff that quickly. Click on it again, it'll bring up the worst ones. So we got Omnicell, First Watch Restaurant, and so forth and so on, all the way down. Another thing you can do is in columns, bring up the sector. So if you want, you could sort it by sector. So you got percentage change and then sorted by sector. Communication services, you can see there were 4 here. Actually, it's sorted by percentage change high to low and then sector. So here's your best performing communication services. There's Upwork. Discretionary. Take a look at all the discretionary stocks. So there's one really bad discretionary stock, another one not so great, and then you've got some others here that most of them have done, did okay. Move on to energy. A lot of energy names reporting. You can see a couple pretty good ones there. Not anything horrible. A couple down about 4 or 5%. So it looks like energy responding pretty well today to earnings. Financials. Again, I'm not going to keep going through this, but you can see what I'm doing here. You can also bring up industry groups. And so we'll do percentage and then let's do it by industry. You might say, well, are there any semiconductors that have reported? Well, there's 4 of them. 3 of them did pretty well. Lattice Semiconductor down 10.85%. But these other 3 here, Axcelis Technologies up 8.16. Zero in. Take a look. See what happened. We gapped up. We've broken the 50-day moving average. 20-day starting to come up. Maybe this is the downtrend that's been broken. Might be a stock that you'd be interested in. But see how quickly we take information that we've summarized for our members and quickly can act on it as soon as the market opens. We can take a look at what's happened in earnings. Anyway, that's about all I got for today. Let's take a quick look at what's going on in the market. Right now, we got the Dow down 254 points, S&P down 0.75%, down 42. We were just at 5,700. Now the S&P back at 5,607. So that was quick 100 points off. NASDAQ down 179 points. That's 1%. Small and mid caps both down close to now 0.6 and 0.8 of 1%. VIX on the move back to the upside, 2453. That's up almost 4%. So that is where we stand right now. Lots more earnings coming out this week. Also, like I said earlier, it's Fed week. So we got the Fed meeting starting today. It's already underway. Tomorrow at 2:00, we'll get the announcement. Put on your crash helmets, strap in your seatbelt, and get ready because we got another Fed meeting coming up tomorrow. Have a great day, everybody. Happy trading.